I would like to introduce a concept that I call momentum gaps. I originally learned this concept from Al Brooks, but he just calls everything gaps, so I had to come up with a name for it, so I call it momentum gaps. ICT has a similar concept that is called fair value gaps, and it's slightly different from this concept. So what you can use it for is that it can help you analyze the internal pressure, the buying pressure or the selling pressure in the market. And it's just a tool that you can pair together with other tools to paint the picture of whether we are going up or down, or whether the trend is weakening or still going strong. So I find that the more of these little tools that I have in my toolbox, the better I can understand the price action. So I don't think you can ever learn enough about these types of little tricks. So what is a momentum gap? So I have 3 bars here, and I have just represented these 3 down bars as lines because I'm not interested in the open or close of the market, only the high and the low. And you can see the momentum gap appears between this low and this high. So this bar was not able to trade to this low. So the market was only traded once at these prices. And this indicates selling pressure. So the opposite would be true for buying pressure then you would have from the high to the low. Now, if this bar was much higher up, then it would start to intrude into this bar and we had no momentum gap. Instead, we would have something called a negative gap. So negative gaps are very common in trading ranges. Pretty much all of the bars are overlapping, and that's why we get this really slow price action, low momentum price action. But when the market is really trending well, you will get momentum gaps. Another thing to note is that sometimes when momentum gaps close, it closes, so bulls would step in and this would close, then it means that the sellers have lost control. And that's always very interesting to see how the market reacts to old momentum gaps getting closed. So observe that. We can also look at these momentum gaps in a wave analysis fashion. So let's say that we have swings, multiple bars forming swings like this. Then we would have a momentum gap here because this high was not able to reach this low. So we would have a momentum gap between there. And this is an indication of a very strong trending market. So let's take a look at this in a real world example to see if we can make some use of it. So here I have a trading range from Bitcoin on the daily time frame, and it becomes pretty obvious early on that this is a trading range, and we suddenly get this really good bull bar that closes above a lot of these bars. So it could be classified as a breakout, and a lot of traders probably thought that it was a breakout. Now we do get a really poor follow through with a doji on that. So that's one thing, but we can also see that we have a momentum gap that is tiny from down here. So we don't have a huge amount of buying pressure down here. In fact, the next sell bar, next bear bar, is less good than this bull bar. It's smaller body and so on. But it creates eventually with this bar a stronger selling pressure momentum gap. And then we have no momentum gaps at all, and we get a lower high and all that. So we can start to pair this technique with your other techniques. And this breakdown starts off really slowly. It's not really until the end of this bar where it's obvious to everyone that this trading range is toast, basically, and we are going lower. So during this bar, or at the end of this bar, the bulls really give up here. So could we anticipate that in some way? So we could get some help with this momentum bar trick. So here we have the first negative momentum bar, the bearish momentum bar, momentum gap, sorry. And then we get another one. So we have now 2 consecutive momentum gaps to the downside. So that's a clue in and of itself. Now, if you were unsure, would you sell this close or short the market here? You have support right here. If you were to sell that close to support, you would need evidence, right? So let's draw these momentum gaps that get created. They get bigger and bigger, and suddenly we get this huge momentum gap. So I'd like you to be aware of the fact that when you get any type of gaps very late in a trending move, it could be a sign of exhaustion, so be careful with that. We do get more good bear bars later on, but we get no bearish momentum gaps. We have run out of momentum gaps. So what happens next? Will the bulls, now that the sellers have dissipated, will the bulls be able to take the price a lot higher? So we can see we have a good bar, but no momentum gap, obviously. A good bull bar, much better than this bear bar, still no momentum gap. Nothing here, and we're just drifting down without any gaps, momentum gaps at all. And we get our first momentum gap, which is a bullish one, right here. So there was buying pressure here, but it faded into nothing with these 2 dojis, and now we're starting to get some more bearish momentum gaps again. So clearly we have more sell pressure than buy pressure. So this is how you can start to use this technique to gain some additional understanding of your price action. I hope it helps. Good luck with your trading.